Let's talk about the right withdrawal rate. A lot of people say, can I just live off the growth and maintain the principal? Dave Ramsey says you can take out 8%. Bill Bengen now recommends around 5%. Susie Orman says you take out no more than 3%. Well, who's right? The answer is there's no one-size-fits-all solution. There are so many factors that go into the decision, including your appetite for risk, your financial situation, your health, your life expectancy, and so on. There's this concept called the 4% rule. Back in the 1990s, an advisor by the name of Bill Bengen created what became known in our industry as the 4% rule. In theory, you could safely withdraw 4% of your portfolio in your first year of retirement, increase withdrawals with inflation, and then historically, you wouldn't run out of money over a 30-year span. And he wasn't wrong. But times have changed. In a recent interview with Yahoo Finance, Mr. Bengen said, in 1994, I was looking at a portfolio with 2 investments, U.S. bonds and large U.S. company stocks. Well, that hardly qualifies as a diversified portfolio. As you increase the number of assets, you increase the withdrawal rates, and I suspect it will probably peak somewhere around 5% when you add in all the other assets. He further explained that he hasn't looked at gold, precious metals, commodities, real estate investments, and other alternative investments. There are a lot of other things that folks can invest in and do invest in. I think there's a pretty good chance that adding some of those to your portfolio will further enhance your withdrawal rates, assuming you get the performance out of the investments. Well, the key word is assuming. And the concept is based on probability of your money lasting. The problem is no one knows how long you're going to live, what the markets are going to do. Would you jump on a plane if the pilot said, folks, welcome on board. We have about a 78% chance of landing our plane to our destination. How many of you would jump on that plane? Probably none of us. You want those odds as high as possible. Retirement income planning is the same thing. In the same interview, the reporter asked, can you talk about someone who's retiring into an uncertain economic environment, whether it's high inflation or a bear market? Bill Bengen responded, my research shows that if early in retirement you encounter a bear market or a sustained high inflation, your withdrawal rates are going to drop quite significantly. If there's anything you can do to avoid that in terms of timing your retirement, it'd be a good idea. See, Bill Bengen is making the case to avoid the risk of bad timing when it comes to retirement distributions in the early part of your retirement picture. The old 4% rule isn't dead, but it's evolving. Research shows that you can often withdraw more if you diversify and segment your income carefully. Predictability, diversification, and compounding are your friends. Hope and guesswork, take that out the door. The best plan is customized for you, built with the most up-to-date research, and adjusted as your life changes. Thanks for watching, and see you next time.